complete rebuilding masterclass. That's what I want to share with you. What we've gone and done is over the last, couple of years, we've put out over, 350 videos. So we went back and cherry picked all the best pieces that I thought if you put it together in a full story will give you the best possible chance you have of rebuilding your credit, understanding the basics. And then obviously there's some repetition in there which we've done on purpose so that you can understand what the big moving pieces are that really matter most with rebuilding your credit. I hope you guys enjoy this. It took us a lot of time to put together. Make sure you comment below. Make sure that you share this with a friend. And of course, view more videos on the channel. All right, let's dive in. I want to break down all the FICO models that they use for scoring. And so FICO data too, like is it pulling FICO 8, FICO 9, etc. We're going to start to upload on the master credit card lender list as well. There's a lot on the screen. Let's jump in and cover this one by one. So let's stick with the big guys here. FICO 8 and FICO 9. Those are going to be the two most common models. FICO 8, most common used, there's two versions of it. There's an auto version and a bank card version. Each one is kind of tailored to what you're getting pulled for. FICO 9 is the newest version that's been rolled out and actually adopted by banks, even though FICO 10 was rolled out in 2020. I just don't think anyone's using it so far. All right, so 8 is going to be more sensitive to high utilization. And kind of what triggered this is there's somebody in the community that was talking about that they kept getting denied from Chase for like month after month, year after year. And I'm like, maybe we need to look at this because this might be the sole reason then. If everything else looks good and you've been consistently getting denied, I'd look at FICO scores. And really, what is that model using and where is it putting weight? Because what's changed over the years and what changes with each model is just simply where they're putting focus, what matters on the report, and where the weight is put. Even though all that data is still being shown, it's just where they're putting the emphasis, right? So with FICO 8, there's more emphasis and they're more sensitive towards high utilization. So it should be below 30%, but even that I would say is too high. So they're more forgiving on one-off late payments of 30 days or more, as long as all other accounts are in good standing. AUs do not show up on FICO 8 model. So if you're trying to add an AU and then get pulled from a bank that uses FICO 8 to get in that ecosystem, might not work the same as you thought. And it might not work at all. So spending $350 to $650 on an AU when you could have just put that same money into, say, a savings account or a checking account to get into the ecosystem, that might be more worthwhile. So you need to know these things. So accounts in collection under $100 balance are ignored. So this means it factors in all collections of $100 or more, even if it's paid off and showing a zero balance. So under 100, it's ignored, but it's still shown on the report. Understand, it doesn't just like delete it or hide it. It's still shown on that report. It's just in the model itself, the score model, it doesn't matter. And then all collections are shown that are $100 or more, or were $100 or more at any point, even if it's now showing a $0 balance. And so a few banks that use FICO 8, and again, we don't have a complete list of this at this point. We will, and I'll probably shoot another video. Chase, Citibank, BOA uses FICO 8. FICO 9 ignores accounts in collections that have a $0 balance. Okay, so slightly different than FICO 8. This also, FICO 9 factors in rental history, authorized users or AUs do count, utility bills count, and accounts medical collections less harshly, so a surgery bill in collections will have less impact on your score than a credit card bill in collections on the FICO 9 model. And so between the two, they're pretty different. You need to know these things going in because, like I said, if you've been consistently denied, that might be a reason why. All right, so FICO 2, 4, and 5, very similar. The main difference is that the 3 is that 2, 4, and 5 use data from Experian, TransUnion, and Equifax respectively, each one different. Mortgage lenders will pull one of each and compile the reports in a document called Residential Mortgage Credit Report, or your Residential Mortgage Credit Report. Duplicated data is screened and removed, and the middle score of the 3 is picked to represent your willingness to pay back the mortgage. Make sense? So that's really the primary differences. Now let's jump into and wrap up with 10 and 10T. The difference is that now for the first time, FICO is offering a regular score or a traditional score and a trending data score. Now, Vantage has been offering this since 2017. So it's not a new thing, but it's new to FICO because the banks basically asked for it. So the T stands for trended data. So if you think of the traditional FICO as a snapshot, the 10T would be more like a short video. Also, the biggest changes in FICO 10 is that they're now going to start looking back 24 months of credit activity. How you've been treating your credit over the last 24 months is going to be more and more important as this gets rolled out. So your score could drop, and really the main factors that we know matter so far, because it's not like they've released this out, like here's the definitive list of what's going to matter, but it seems like this is the big areas of focus. If you took out a personal loan to consolidate on credit cards, that's not going to hurt you. But then if you went out and ran up the cards again, or went out and looked for additional credit after that, that's going to negatively affect you. So basically what it's showing is like, yes, you went out to get a personal loan, you consolidated credit cards, good on you, but then you ran the cards right back up and the personal loan is still open. So I assume that if the personal loan then got closed out and then you ran the credit cards up, that wouldn't matter the same way than what I just described. If you're using credit cards to get by and you just don't seem to whittle the balances down, or your balances are growing, this means that if you're keeping them at a high utilization rate and not really paying them down, paying $100, $200 a month without consistently, like let's say a couple times a year, wiping off the balances completely, well then that starts to look bad because it looks like you're living off your credit cards, right? And then the last one is if you missed a payment, the penalty for going 30 days past due will be even harsher than under previous FICO scoring models. So it's really tough, man. Like they're tightening up quite a bit on this new scoring model, because any late payment, any missed payment is going to affect you more. Living off your credit cards is going to affect you more. Taking out a personal loan and then maybe some emergency strike, so after you just paid everything down, then you run them all back up and the personal loan's still open, is going to affect you more. And they're looking 24 months back in history. Now again, one denial, I don't know if I'd be looking this deep, possibly, but if you're getting consistently denied, I would actually start to look at the different FICO models and try and figure out if that same bank is pulling one of these models and what this model is then telling you about the focus of that report and that score, and that could be definitely a reason why. So then we know those things, we go to work on those things, like whether it's utilization, late payments, etc., remove those off the report, go again and see how we do, right? We're trying to get approved at that bank.
Every single Vantage Score model explained. I've got some nice pretty little graphs and pie charts to follow along, because we can use similar to what we look at with FICO. That being said, Vantage is quite different. Vantage was created in 2006 when literally the three credit bureaus, Equifax, TransUnion, and Experian, created it because they were trying to look for a competitor to FICO. FICO was the only model at the time. So here's what's interesting is prior to the Vantage Score, each of the credit bureaus used their own credit scoring model, essentially, which led to different outcomes in the credit scores. And even in the same credit report, you would see a wide range of different scores, because this obviously confused people, maybe made them mad, and people weren't really following along with it. That's why they decided to sync up and launch Vantage, right? Which now we have Vantage Score, FICO, and then there's a ton of second-tier data aggregates and data furnitures that help feed the primary three credit bureaus to decide if they're going to extend your credit or not. Here are essentially the categories. We have payment history, which is extremely influential. Age and type of credit, highly influential. Percentage of credit limit used, highly influential. Total balances and debt. Notice how that's separate from percentage of credit line used. We have two separate things saying the same thing. Interesting, right? And so total balances and debt is moderately influential, and recent credit behavior and inquiries, less influential. Available credit, less influential. Okay, so here's the first nugget. This is one of the reasons why you can see such a huge difference between your FICO scores and your Vantage scores, is because of a few different things. The main one being that they look at utilization on a card-by-card basis, and they look at it both on the consumer credit card side and the installment side. So because those factors are both separated and not grouped together like you see in FICO, that can be a reason why we see those big differences. So things like A0 and having all your utilization on like one or two cards that are like 70 or 80% on the limits, but the rest is at zero. That's why those strategies don't really work on the Vantage side, is because they're looking at across the boards. Make sense? Okay, so that's the big thing to note here. And lastly, just to nail it home, is I told you that they look at the total balances and debt and the percentage of credit limit used as two separate categories, as well as a third, if we wanted to throw it in there, as available credit, which is less influential. That works out to be, I think, like 1%, right? So doesn't matter though. We have these categories broken out into three separate things to kind of cover one topic and one category that you would see over on the FICO side. All right, Vantage 2.0 and all the previous models. So before, they operated off of a 501 to a 990 credit score system. Instead of 850 being the max like we see in FICO, you could have up to a 990, which would be wild, wouldn't it? It'd be wild if you could have like 1,000. Just because it's like so many people, it's so ingrained in their brain for 850, it'd just be wild to see. Higher scores are obviously better. Vantage Score assigns a letter grade to each of the consumer's credit scores as well at this stage. And the letter grade takes the guesswork out of figuring out what's good credit score. Okay, so here we go. We've got 900 to 990. That is an A. That is super prime. 11% of consumers are super prime. Then we have 801 to 900, and that's a B. That's prime plus. 29%. We've got 701 to 800. That is a C. That is prime. 21% of people fit into that category. 601 to 700. That is a D. That is non-prime, and that is 20% of people fit into there. And then we've got high risk, which is 501 to 600. That's an F, 19%. That was the letter grade system. And obviously we've got in front of us the actual pie chart here. So here is the weighted factors and how they look at it, right? We've got 31% to recent and available credit. We've got 28% to payment history. So payment history across the board with FICO Vantage, super important, right? So having lates, having bad payment history is going to affect you across the boards no matter what, okay? Just like having overall bad utilization or large utilization, 50% or more, is going to negatively affect you across both scoring platforms as well. Way more on the Vantage side than you'll see on FICO, right? Next, 23% for utilization, 9% to balances. Again, utilization and balances, kind of saying the same thing there. 9% depth of credit, that's, I think, a fancy way of saying age. We're going to read the notes here in just a second. 28% to payment history, whether your payments are satisfactory, delinquent, or derogatory. Utilization, the amount of credit you've used. Balances, the amount of recent reported current and delinquent balances. That's interesting. So delinquencies are essentially affecting you twice. Payment history side and balances. Depth of credit, that is the length of your credit history and types of accounts you have. Okay, like I said, that's like credit mix. Recent accounts is 30%. Number of recently opened credit accounts and credit inquiries. So here's the last one. The recent credit and an available credit. Available credit is just 1%, but that's grouped in with recent and available credit. Remember, that was 31% altogether. So recent credit is just the number of recently opened credit accounts and credit inquiries. And then available credit is the amount of available credit on your credit card accounts. So after 2.0 launched, there had to be revisions, right? Just like there's changes in FICO. Like we went from FICO 2, 4, what do we got? 6, 8, 9, and now 10, I think, is how FICO went. I don't know. We got a dedicated video on FICO. You can watch all that. In 2013, Vantage Score upgraded to their 3.0 release, which to this day is still the most common release that you'll see out there. It is the most common Vantage Score that you will get with, what is that, NerdWallet, Credit Karma, Wallet Hub. Credit-wise, I think the free one that you get on the American Express or Amex, and probably a bunch of others, that one all tends to be Vantage 3. There's only 1 or 2 of them that even offer Vantage 4.0. Like I said, Vantage 3.0 is the primary one used. Okay, 2013, that's when they launched it. The reason why this has lasted so long is because that's when they adopted, first and foremost, the 300 to 850 credit range idea that FICO had. Okay, so now they're both basically the same in terms of the number. Vantage 3.0 calculates credit scores based on the following factors. Payment history is 40%. Credit used is 20%. Total balances and debt, 11%. Recent credit behavior and inquiries, 5%. Available credit, 3%. So you see, we've made some changes. Additionally, Vantage 3.0 forgives consumers for delinquencies during natural disasters. That seemed to be a highlight there. It rewards high-quality consumers for paying off mortgages, ignores collections. So does FICO 9, and the upcoming FICO 10 and 10T also do as well. And it minimized authorized users. So again, expect authorized users to hit differently across your FICO and your Vantage scores. Most people don't care because they're looking at FICO. Vantage 3.0 also weighs late mortgage payments more heavily than other late payments, allows just 14 days for rate shopping for a car or mortgage, counting all inquiries in that time as one, compared to 45 days with FICO, or you could just get them removed. And here's the breakdown. So we've got the 34% of amount owed, that's 20% utilization, 11% balances, 3% available credit, 40% payment history, so that importance went way up, 5% for utilization, and 21% for depth of credit. Okay, Vantage 4.0, that's what most of you are here for, so let's dive into it. It was rolled out in the fall of 2017. It was introduced with improved ability to score consumers with limited credit history or no credit history. More on that in a second. The company says it uses machine learning to help score these consumers. The 4.0 model includes trended data, which looks at your credit usage over time rather than taking a snapshot at one moment in time. This is similar to what we see with FICO 10 and 10T as well. It goes back looking upwards of 24 months. The updated model also places less importance and weight on certain negative reporting items like medical collection accounts, tax liens, and public records. Okay, so here is the breakdown for 4.0. You'll see we've got 41% as payment history. Notice how that's just like getting bigger and bigger part of the pie, right? Age mix of credit is 20%, utilization is 20%, new credit is now 11%, balances 6%, available credit 2%. So we're still literally covering 3 categories that say the same thing: utilization, balance, available credit. So this is 28% of the pie chart here is still being covered with balances, right? And how much you're actually using. So interesting to note. So there you go. There's the differences between 3.0, 4.0, and 4.0. I guess if I were to say anything about it, it's using a lot more machine learning, just like FICO 10 and 10T, and it's looking back at a longer period of time to see how you're using your credit, which is very similar to 10 and 10T. All right, last thing I want to touch on before we wrap up the video, it's worth noting that the biggest difference, I guess you could say, between FICO and Vantage Score is that FICO, you need to have 1 or more accounts that have been open for at least 6 months and at least 1 account that is reported to the credit bureaus within the past 6 months. Otherwise, you won't get a FICO score. On the other hand, with Vantage, they can use data from just 1 month's history or 1 account that's been opened within the previous 24 months. That's pretty crazy. So if we're talking about just the pure benefits of getting more people into the credit system, Vantage wins all day, hands down. So anyways, if you're new to credit or haven't used your credit in a while, then the FICO score, you most likely won't get one. But with the Vantage, there's a higher likelihood that you will. Let's wrap up with where you can check out these scores. I talked about Credit Karma, Wallet Hub. Let's see what else. Credit CSAM, CreditWise, NerdWallet. With Navy Fed, getting a checking and credit account, you'll be able to get your Vantage scores there. Amex, you'll be able to get your Vantage. There's plenty of others. I'm sure there's so many out there. In this video, we're gonna cover how to boost your credit score in 30 days. All right, so first off, we have to reference the infamous FICO pie chart. There's 2 things that I wanna point out here, okay? There's amount owed, which is 30% of your FICO score. And then there's payment history, which is 35% of your FICO score. So together, those 2 things are what? 65% of your FICO score. The first thing we need to do is lower utilization. Now, this can be done many different ways. And again, it can be done through the lens of temporary or, long-term fix. Simplest thing to do is just pay more money. So pay more down on the debt before the statement date. This is where you can actually start to play the game because there's 2 dates that you need to know. There's the payment date or the payment due date and then the statement date. Those dates are usually not the same. The statement date is when it generates new statement, which then calculates how much interest you owe on the credit card, the installment loan, etc., right? And then the payment date is just when you got to make the payment. So if you want to game this and get ahead, whether it's for a short-term window to make your credit profile look a little bit better or long-term, you want to make sure that you're paying more down before the statement date. You guessed it. Okay, next is, speaking of utilization, remember this, is if we are over 50% utilization, expect your credit score to drop by 50 points at minimum. And if you're over 70% utilization, your score is going to drop by at least 100 points. I've seen it and I've done it, so I can speak directly from experience. All right, next, number 2, we want to catch up late payments. So we already dealt with 30% of the credit profile. Now let's deal with the 35%. Payment history. Well, AKA late payments. Late payments are insane actually because first off, they can drop your score 50 to 100 points. Next is they can stay on your credit profile for 5 to 7 years. So it's like the same as a bankruptcy. You might as well just go bankrupt instead of missing a late payment. So it's that valuable to your credit score to just please do not let that happen. And so there's a few things we can do here. If it's the first time you've done it and you literally just did it, like this month, last month, call them. Call the creditor itself. This is the first time this happened, blame COVID, blame your grandma, blame anybody. Make it convincing, create a good story, and just, essentially beg for forgiveness. If they say no, hang up, call back till you get a good rep who's having a nice day, who's happy, who wants to help people, they're excited about life still. You want that type of person because they're gonna be the one that's like, hey, okay, let's get rid of this. And if it's older than that, then you're gonna have to go to work. Whatever angle we're trying to play, it's like, it's an open account. You've been paying it. It's really hard to win that. So your best bet is a goodwill letter. And if it's got a legal letterhead, if it's like written by a lawyer with legal verbiage used and that kind of, lawyer tone, you're gonna have a better success rate than if you write it yourself. But if you did want to write it yourself, just make sure that you get some sort of legal head and it'll do much better than, again, without it. What else I've noticed that's interesting is if a late payment is like 4 years or older, just forget about it. Don't really try and do anything with it because it doesn't really seem to impact your score that much. And these are due to changes with, FICO 8 to FICO 9 and now with FICO 10, these kind of like short-term issues that you have, they go away fairly quick, right? So that's what I would suggest there. Again, late payments is probably the most difficult one that you got to face. So lastly, if you're having issues with, making your payments, or you're forgetting, you're constantly like waking up in the middle of the night, stressed out, thinking, did I pay that one? Make yourself some simple alerts. You can do this in Google Calendar. You can do this with some sort of other software. You can spend all kinds of money, I'm sure, creating software or, using some other paid software to do this. But we could just use Google Calendar and just, put in those payment dates, or put it in a few days before the payment date, because trying to make the payment on the payment date is a bad idea. Or another way you could do this is to set up auto billing. First off, I'd rather have my account overdraft any day of the week than be late on a credit card, because I can go and fix that. And a lot of these banks are still giving you leniency on overdraft fees, especially on business accounts, because they know that times are still tough. So I can go get leniency on that a whole lot easier than I can go get leniency on a late payment. So overdraft my account all you want, as long as I get that credit card payment made on time. That's the way I look at it. And then the second thing you could do is just do the minimum payment. Like, you don't have to make some big audacious payment with the auto pay. Just do the minimum. So then, okay, that's done and dusted. That's covered. It's going to get paid in time, with plenty of time for it to clear, and no issues are going to happen or goofiness on the payment itself. And that would be a way that you can ensure that you don't have this issue. All right, number 3, remove collection accounts. So if you've got collection accounts sitting on your credit profile right now, we need to get to work on those. Here's the tricky thing is, out of the gates, if you're going to do letters, expect at least 4 rounds of letters. And if you're going to do this yourself, you could hire somebody, a credit repair, etc. But there probably are some good ones out there. But if you wanted to handle this yourself, expect, 4 rounds plus of letters. Now, the next thing that's kind of weird with all this is, okay, so we're calling this debt company, or this company that holds the debt. We're trying to get to a point of them not playing games, messing around with us, without really admitting who we are. Because there's something tricky and shady that a debtor can do when they're talking to you. If they can get you to confirm your name, confirm your information, they could, not saying they will, they could report an update to the credit bureaus on that debt, which in some states restarts the debt cycle. So what do I mean by that? Is after a certain amount of years, we can use the fact that it's a dormant debt essentially as the means to remove it. By locking down second tier bureaus and the type of lettering that we use, we can actually point the two at each other and say, hey, he's the bad guy. They can't double check it. And then so, oh, yep, must be right, because we can't double check that data. And then that's how it gets removed. And so the longer it sits dormant, the better for removing it, the easier it is to remove. That being said, is the minute we call them up or try to talk to them to work out some sort of pay to delete or pay to get rid of this in some sort of way, is they could, if they wanted to. If we don't follow through, fast enough or whatever, they could update the debt, and that would kind of restart that clock. I'm pretty sure that still exists. If not, correct me in the comments section. Keep in mind that it'll still show up like the lates and everything, all the history leading up to the collection, but at least now it'll show a settled account. That's not ideal. It would actually be better if it was just removed completely. So that's why a lot of people opt to not pay it, and then they just try and remove it. Again, that's up to you. I'm not a credit repair guy. Number 4, wake up old cards. So we've shared this story several times now, but George Washington lost $77,000 with FNBO because they were cards that he didn't use. They were sock drawer cards. He wasn't even putting minimum spend on them. And because of that, they shut down the accounts. We do not want to be losing trade lines or having trade lines cut because we aren't using them. So we have to come up with some sort of process to rotate through a minimum spend, $5, $10 on these cards so that they stay active. The longer you leave those cards inactive and don't use them, the higher your risk or the higher the chance of them either cutting the limit or closing the account. And we don't want that. So we have to use these cards. Again, we've already got enough that we're trying to fix. The last thing we want is some curveball out of left field that's slashing a credit line that we didn't see coming, right? That'd be horrible. And that can affect your credit score, because again, if we're at this super sensitive place to where our utilization is high and our credit score has been affected by that, is if we were to have a credit limit now slashed, we could start to see a series of adverse reactions, like a avalanche or a snowball effect of getting more and more and more and more. And then we're just all the way down, pinned against the wall now because of that. And that can drop our score because now our utilization looks even higher, which would then trigger that. Number 5, get new credit cards. So this is going to be way trickier when you've got high utilization and the score is below 680, because 685 is really that minimum. But there are some options that we've got. So let's go over that. First, we want to focus on fintechs that will not pull your credit score at all. Maybe they're hooked up with Plaid or IMAX or some sort of link up your checking account to get approval type of card. Like we just covered the Rocket card recently. That's another Deserve card. The CrowdFit card, any of the Deserve cards do that. You basically just upload your ID, take a selfie photo, and then link up your bank account, and then they'll approve you based off of that. So anything like that, we want to stick with that. And then anything that will be a soft pull and tell us the limit that they're going to give us before hard pull, or there's just no hard pull at all. So those are the only offers that you really want to look at. And there's quite a bit there. There's Gemini, there is the Apple card, there's also the GM card by Goldman, and who else we got? We got all the Deserve cards. Yeah, there's probably some others. Go check out our soft pull credit page, and we've got like 80 something offers on there. So you'll find plenty on there. So those are the types of cards that we want to stick with, because why do we even need new credit? Like why should we be doing that? The limits are going to be lower, yes, but we need fresh credit so that overall it lowers our utilization. That's it. That's all we're trying to do. So by us getting more credit, it makes the utilization gap better. Make sense? Okay, number 6, become an AU. AU meaning authorized user. Now, it's been a while since I did this. It hasn't been since like 2019, and I know that things have changed. Some of the credit cards who are reporting full history have changed. How long it takes them to report has changed with some banks, I'm sure. Are they still all reporting to all 3 bureaus? I'm sure we've seen some changes there, but AUs are still really, really powerful. Now, this can be used in 2 different ways. We can use this if we want to go get credit at a new bank, we'll go get an AU at that bank, so then we're starting to share data points. But as I've shared in previous videos, you could go get a safety deposit box, you could go get added onto somebody else's account, or a lot of other ways to get into that bank, so then they can start to send you targeted offers. If we didn't want to do that route, and or we wanted to thin out our utilization, get added on some AUs. So that is a shorter term fix, unless you know the person, because AUs are not cheap. So they're only going to stay on your profile for like, I don't know, 60 to 90 days. I've seen some last longer, take a while for it to get kicked off, but expect that it's somewhere between 30 to 90 days for all of them. All this falls into a very quick, actionable 30-day window that we could actually do this, right? Number 7, keep payments on time. This should be an obvious one, but like especially during this 30-day blitz or during the rebuilding process, you do not want to miss a payment. And I've already harped on that enough and stressed on that enough. We do not want to be missing payments on this. So again, keep up on that. Set yourself alerts, reminders, 1 day before, set up auto bill. I've given you the solutions, run with it. Okay, and number 8, lastly, diversify. Now, I'm not just talking credit mix, meaning credit cards, installment loans, mortgages, car payments, all that. I'm not just talking that. I'm actually talking something different. I'm talking within the amount of credit cards that you've got, we need to diversify. Again, regardless if you're using the card or not, keeping a balance or paying it all off, they came in slash limits. George Washington lost $77,000. So I know that sometimes people question, like, why would you want so much credit? That is one of the reasons why, is because we never know a Silvergate, Silicon Valley Bank situation happens, or they just do like FNBO, like Synchrony, Community does this as well. All these store credit cards do that to where they just cut and close accounts for no reason. Any bank actually can do that at any given time. So let's not forget that, right? Let's remember that. That's why we want to diversify. So we want to have our hand in enough pies to where, again, if they were to shut this down, it doesn't affect me and destroy my life. Okay, let's say that 77,000 was 50% or 60% of your total credit, and they shut that down overnight. Your score tanks 100 to 150 points. Adverse actions start flying in. Everyone's cutting your limits, closing accounts. Your whole life is ruined. Your whole life is ruined over one decision that one person made or an AI made that had nothing to do with you. Crazy, right? So this isn't a game with what we're doing. I need to make that crystal clear. And that's why we want to diversify.
Utilization, I think, is the most important key on your credit report. Outside of everything else, I think this is the number 1 killer of your credit score. I know that everyone thinks payment history is number 1, right? And it's simple. It's 35% of the FICO score. Here's our FICO score model right here, okay? I don't think it is. I think amounts owed, I think utilization matters way more than maybe this model even utilizes, or with how they actually are factoring on the backside. Over the years now, probably the last 3-4 years, I've now encountered hundreds of people who they've got lates from 2-3 years ago. They've got derogatories on their account. They've got bankruptcies from 2-3 years ago, 6 years ago, 10 years ago, 11 years ago. You name the amount of time and they've got it, but they've got low utilization and they are getting higher limit cards than people who should be getting higher limits than them. So how are these people able to do this? I think it's right here. This is my thoughts. So this is what I think is absolutely 100% true. This is where everyone's putting their focus, right? Remove the late payments, remove the medical collection, remove all that. don't get me wrong, a collection is devastational, especially if you've got lates like in the last year or two, very hard to get over. That being said, I would argue that relationship banking is the most important thing you could focus on anyways. I've seen this to where there's a 2 or 3 year old collection or bankruptcy, and these guys are getting high limit cards because their utilization is 1%, 5%, etc. Let's look at this. FICO score range from 300 to 850, right? Look at how this breaks down for average credit utilization ratio. Obviously, the very poor to fair scores, which is 300 to 669, which is the bulk of people, are sitting with way too much utilization. And it's a double-ended sword. It's like it feeds itself. How are you supposed to get out of it? You can't, so you spend more, or whatever comes up, and emergency comes up, or gosh, name it, over the last 2 years, right? And then this just keeps going up and up and up and up and up and up and up. But this data is from 2020, and it's the first time that we saw a huge decline in utilization ratios over a 12-month period ever. Interesting how this also counts for 33% of the population have a poor credit score. Percentage of population 16 and 17, that's like 33%. So 33% of the population have a poor to fair credit score. Most people actually now have a good credit score on both FICO and Vantage. So that's the good news. And credit scores are gradually going up year after year. Another good thing is credit scores tend to go up the older you get. The older you get, the more you realize how important it is, right? Now let's look at the opposite end of the scale. Those with 800 to 850 are only utilizing on average 5.7% of their credit. That is absolutely incredible. And this amount of people is 21% of the population. Now, understand that I think FICO right now ranks about 236 million people. This is not a coincidence, these two factors. Okay, so there's a lot of things that coincide together. And some of it's unfortunate. I know some of it's probably triggering, but there's 3 things that coincide. Higher net worth individuals have higher scores, higher earners have higher credit scores, and those with higher credit scores have lower utilization. Again, it's cyclical. Just as it's cyclical at the bottom, it's cyclical at the top. So those with good credit scores tend to keep good credit scores or keep getting great opportunities come to them. Average FICO score in the US right now is 716. Average Vantage score is 695. Both are considered good, like I said. Things are looking better, but we've got to change something here. Like, we've got to absolutely change these lower percentile brackets, right? This is just too much of the population that is falling into poor to fair category. I would argue that this is your single-handed best weapon. Now, I don't know how you're going to get there, right? Maybe you can actually get a good personal loan, right, through a good creditor like Goldman, Marcus, Discover, Amex, somebody like that, to where they're not going to gouge you out with interest rates. It's not going to be subprime. It's not going to end up being over 200% when you pay it back. It's not some payday loan type crap, but it's got a good rate to it, and it's not predatory, and it doesn't require any securedness upfront or anything to secure it. But you might not be able to do that. I'm telling you, though, that there is a lot of value in still doing this. Even though FICO 10, if you don't use a personal loan properly, FICO 10 and 10T is going to penalize you when that continues to get rolled out. But if you use a personal loan properly, then there's nothing wrong with that. They will not penalize you on that new scoring model, right? So if we could get a loan and pay down the high utilization cards, our score can jump upwards of 100 points. There's a million things we could talk about in terms of benefits. We get better APRs the higher our score is, because as we go through the brackets from good score to very good to exceptional, the amount of sub or sign-up bonus that we get, the interest rate, all of that completely changes. But at the subprime end of the scale, we are paying so much more. Car loans, auto loans, mortgages, credit card APRs, everything you can imagine. And that's on top of everything else that you're already paying in terms of inflation, taxes, etc. Now, keep in mind something too. This is a little bit dated of a survey now, but 90% of lending decisions are based off of the FICO scoring models. Now, for some credit limit increases, like I know the Synchrony Bank Amazon card, as well as I think Navy Fed still does this, they will utilize Vantage TransUnion. I think it's 4.0 that they'll use for that, for a credit limit increase. But outside of that, like most primary to get in the door especially, will utilize FICO. So FICO is where the attention should be, because that's where most of the action is happening. This, you could spend a ton of money with credit repair companies, never getting this stuff off your report. It's still, to me, it's not going to be as important as this, because once we get these things paid down, our utilization goes down, okay? Our score goes up, but our opportunities go up as well. So then our opportunities allow us to get more credit to then continue to thin out our utilization. Yes? And then these things just get snowballed. because clearly where we're heading with the ultra FICO model and a lot of this, the fintech stuff where they're using these alternative scoring models, is where we're heading with a lot of this is linking up your checking and savings account, being able to prove that you got cash on hand, not going negative, no non-sufficient fund fees, no, funny business like that happening on the account. And that is proving to now be valuable in terms of staking up reputation to then get something in return. In this case, credit or credit score. And FICO is working with Experian and all the top vendors anyways with this new ultra FICO model. So, and FICO's already the big dog, as I told you. It's unfortunate, like I said, that lower scores and lower utilization give lower opportunities as well. So lower score and higher utilization tends to be lower income earners as well. And lower income earners get trapped. The highest interest rates, they got the highest utilization, they got the lowest amount of cards, the lowest amount of total overhead credit card limits, right? Those are lower. They're getting $500 approval cards, $1,000, $2,000 a great card. I remember that. And I've also too lived off of cards to where they're floating somewhere between 75 to 90% maxed out all the time. At some point, you got to change that. You got to reprogram that. So we got to find an edge, whether we're going back to school and getting more education, going to YouTube University, getting courses, something to where we can increase our edge to make more money or start a side hustle so we can get more cash flow in to then do this. But I'm telling you, this is where we want to put our focus. If everything's turning relationship based, Navy Fed considers DTI one of the most important variables, debt to income ratio. That's utilization once again. Right? And so many companies now are willing to look past derogatories, especially if they're over 2 years old. But I'm sure you've heard it, right? Somebody that just went bankrupt a couple years ago, and now Amex just gave him a 3K card, a 10K card. How's that possible? How come this guy got it and I didn't? Because I'm telling you, this is where we need to put our focus. High utilization is the number one credit killer. Here's what we're up against. I'm going to share it to you in 4 charts. It's going to be the easiest thing you've ever looked at. M2, this is the money supply. This is how much money that they've printed. Well, last year alone, over 2020 to 2021, they printed 40% of the circulating supply of the US dollar in 1 year. That's never happened in the history of fiat. Okay, now looking good. Our purchasing power. This is from 1913 up to 2019. I'm sure you've seen this before. 0.05 cents is about the value that you're getting out of each dollar. Personal savings rate. So this is deteriorating trust in the US dollar. There's too many dollars floating around. Everyone knows it's worthless. So is anyone saving it? No. They did during COVID because uncertainty. But now that, game's back on, well, we're back down to 2008, 2009 levels of personal savings rate. And where is everybody playing? Are they playing in the realm of real financial assets, which is where all the high income earners play and invest their time and money, which is land, it's real estate, it's boats, it's tangible stuff, it's commodities, it's collectibles, it's art, it's that sort of thing, or financial assets, which are risk-based equities, government bonds, all of that. Here's your answer to that. And I've shared this chart quite a few times. Everyone's playing in the financial asset game. And what's interesting is even high earners, they have even more financial assets as well. So they have real assets, financial assets, they have everything. This is where it's come to. Nobody's saving because the dollar's deteriorated and the trust in the dollar is deteriorated. So everyone's going to alternate things to get yield, to get value. What's the average APY on a savings account? 0.010. An insane amount to get 0.7, which I think is like what? Less than $10 a year on $1,000 if you added no more money to it? How is that ever going to get you ahead?
Let's talk about options that you've got with high utilization. I don't got a lot for you here. That being said, I think a combination of these things deployed together will put you in a better position, okay? So first things first is pay down the balances. So we got a high utilization across the boards. Understand that the minute that you cross over 50% utilization, expect at least a 50-point dump in your credit score. The minute we cross over 70%, probably 100 points or more. I've done this. I've lived through this. It sucks, even if it's temporary. Now, the good thing is that if it's temporary, meaning like probably 30, 60 days, it's not going to affect your FICO 10 scores. But if it's longer than that, it's going to negatively affect your FICO 10 scores, as well as FICO 8 and 9, right? As soon as you pay that off, scores go back up. That's the first thing we could do. And pay it before the statement date. Like, you want to get those payments fired off as soon as possible, essentially, because we don't want another day of interest adding up against us. We want to get rid of that as soon as possible. Let's say I'm sitting on a chunk of money, but the chunk of money isn't enough to pay all the limits down. That's when we can deploy something like A0, where we just pay all the small cards down and then we got one banger with like 70, 80% utilization. That's better than trying to pay $1,000 down on all the cards. I personally think so. It's not set in stone, it's not a guarantee, but it's better from two things. My mental health is now I know that it's just one card. And then secondly, easier to manage. And thirdly, I do think that it benefits the credit profile more positively to do that. That's how we would handle that. And then obviously if you've got enough money, but you're just like not wanting to deploy that cash, or for some reason you're being like stubborn or stingy with your money to not pay those cards down, as soon as we pay those down and reset them, everything resets, our scores go back up, and we can go get more capital. Please do it. I know might not be the greatest thing, or maybe you got regrets on some of the shit you bought with it. We got to do that though. We got to get those limits paid down because we are getting eaten alive with that 20% plus interest on all those cards every single month. Okay, next thing you could do is you could get a personal loan, use those funds to pay down all the cards, and then you're left with an installment loan that's, sitting at like 90, 100%, and you're sitting at, essentially no balance or very low balance, below 30% utilization on the cards, which does what? Then gets us back in position to go get fresh credit. We're just trying to get this to look good for a statement date or two. Remember, Amex pulls like 30, 60, 90-day-old statements. So you got to wait a couple months before you go out and try and get fresh credit. But then the first thing and easiest thing we could do after a couple months, go try to get credit limit increases. Because I guarantee you haven't really been trying because our utilization has been so high. So now we can go back, get credit limit increases, and let's get some fresh credit, and bang, we're back in action. And then if we get zero balance transfer cards, maybe we can use that again to pay down the personal loan, and we're just moving around money at this point. Make sense? In FICO 10T, there is the personal loan piece is looked at not negatively, but it's starting to get weighed in if we go and do this to where we deploy a personal loan to pay down our credit cards. They can see that, they know it, that's being reported as a actual metric now. So let's say now that just a couple of them are, or we've got a couple that are either sitting at zero balance or really good balance, try to get credit limit increases on those. We could go back to pre-quals or offers that have no hard pull at all, like any of the deserve offers do this, and we could go and find out what we're gonna get. They don't give you the rate, but we can go through the whole process with no hard pull. Those are the types of offers that you wanna get, and then try to get brand new credit to then thin out our utilization. Next is get some form of AU, right? So some form of AU to help us tackle this. And this is gonna be a short-term window. Average AU stays on for, 30 to 90 days. In that timeline, we now have to get to work on that happens, our utilization drops, go get credit limit increases on as many cards as we possibly can, and then try to get new credit. I would say try to get new credit first, because the credit limit increases are gonna need a month, a statement or two to reset before you can really go after those. Go after the new credit first. And then again, hopefully by the time the AUs fall off, we have fixed the problem. We've got a lot more credit, or at least a little bit, and utilization doesn't look so bad. So that's an option we've got. And lastly, last resort option that I've got for you is you've got a day job. You've got a set of skills that you've been honing for the last, 2, 5, 10, 20 years. I'm gonna assume that your day job has to do with your primary skills. If it does, what we're looking for is we're looking for a side hustle outside of work hours, doing the same thing that we do at work. I don't know how you're gonna do it. That's not the point of this. I'm just giving you the sauce, what you need to do. You figure out the how. Whether this is taking on side contracts, whether we're doing some sort of consulting or anything, build up your personal brand. The personal brand should always be getting built up because it's something to fall back on. And in this scenario, it would absolutely save you to have that. Now, if you've got skills that are outside of the job that make money, which most skills do, then go and put yourself on freelancer sites, go and put yourself on these different platforms to make side money. Fiverr or Elance, Freelancer, all of these places exist for you to make side hustle money. It's not just like, driving people around and doing the Uber stuff, which I guess you could do as well. There's other means that we could use, and that's the primary one. So let's take other skills that we've got, turn that into a side hustle, side stream of revenue. And then if we have no skills and you have a job, but there's no way possible to get, more money off of that, to get a raise, to get a side hustle, doing the same thing, any of that, let's say all of that, just you're striking out. Go to YouTube University, go to Teachable, go to one of these platforms, pay money and learn new skills. Then go take those new skills and make more money with them, okay? let's define what a thin credit profile actually is. Now, Experian has probably by far the clearest explanation for what a thin credit profile is. 5 accounts or less or fewer reporting is considered a thin profile. Now, some people want to debate this, 4, 2, whatever. All it really is, in short, is that we don't have a lot of history, don't have a lot of accounts, and we don't have diversity of accounts, meaning that we don't have installment loans and mortgages and auto loans and revolving credit cards and all this stuff reporting for a really long time. Just essentially means that you have too few accounts to create a full picture of credit worthiness for potential lenders. It also might mean that you have none. So you have no credit score because you have no trade lines, nothing being reported to your credit profile, okay? So those are what we're considering a thin credit profile. Again, we're assuming that you don't have derogatory accounts or late payments or anything like that going on. What's our options to fatten up our profile? Well, I got 7 for you. First one, authorized users. We just touched on this briefly. Family, friends that have, set up long established credit histories for, who knows, 3 years, 10 years, 20 years. And as long as the payment history is great on those and the utilization is below 10%, add it on. Now, if you don't have family that you can do that with, let's say you're a whole family of immigrants who've come over here and none of you got credit, well, then you're gonna have to look at buying access to somebody else's AUs. This is kind of somewhat slimy business still, only because first off, out of the gates is even if you're added onto these accounts, a lot of them will only stay on your credit profile for 90 days or less. Some of them, they'll stay on for a really long time. Like I've had a few Citi accounts that still, for some reason, still show up like a year later on some older Vantage scores and things like that. So again, your mileage will vary. I don't know what it'll be for you, but understand that like 90 days would be a good amount of time to expect AU to show up for. So you've got to like kind of get this done in a small window of time. You've got to like make your whole plan, pull the trigger, fire off and get those AUs added. They get added, then you go and try and get your new credit or whatever you're trying to do with this, right? AUs are still extremely powerful. No matter how much they try and downplay these with FICO 10 and all these different models that they're rolling out, AUs are still here, okay? So they're still really, really powerful. Next, credit builders. So we're gonna break this up into 2 different categories. So these are 2 points here. We've got regular credit builders and subscription credit builders. First off, credit builders, these are usually a no hard pull credit product that's offered by a bank or institution, and the sole intention is to build credit. That's it, okay? So they're usually more lenient, they're usually more flexible, and you pay in every single month and it reports towards this overall trade line, right? And the trade line is what's reported every single month. Online payments, all that works the same. Usually these are also reported as a installment loan. South Inc. comes to mind, Credit Strong. Look, we've got some here, Kovo, Kickoff, Meet Ava, that's slightly different. And then Lockbox, okay? So that's those options there. And then the other option would be subscription. Here we go right here. And so subscription credit builders, just to split this out on its own, are simply the same kind of idea or concept, but the monthly subscription payment that you're already making to Netflix or whatever, HBO, Hulu, whatever you're paying for now, you do it through this service and they report that as an active trade line. Now, some of these are really small, some of them are much better. Like Grow Credit, for example, we did a dedicated video on that and people saw upwards of a 50-point credit jump when they got that added and it started reporting. Stellarify is another one, and that's where Meet Ava comes in at. Meet Ava actually does report as a $2,500 credit line, which is the largest out of the group. We did a dedicated video on that as well because somebody recently got that added to their profile. So those are options you've got there. Lots to do there. And the rent thing, even though I don't have that listed in the 7 here, you could get your rent or utilities added as well through your landlord. There's a lot of different options there. Let me just show you that really quick. Utilities, we can go through Experian Boost or eCredible. And then for rent trade lines for you to do yourself, you got Rent Reporters, Boom Pay, Rental Karma, Level Credit, Rock the Score, Credit My Rent, and Payment Report. And then there's a bunch of different options on the landlord side. So next is you could do secured credit card. This is very simple. We dictate what our limit is going to be. We put up the money and secure that trade line with the amount of money that we want not only the card limit to be, but also what it gets reported as. So a lot of these, I'd say 99% of them start at $500 and go up. A lot of them cap out at like $5,000, but I've seen some crazy ones. I've seen up to $30,000 on a secured credit card. It's really just whatever you want to do. So that'd be a great way to not only, break into the door on that bank or institution and start to build a relationship there, but also too, to get another trade line reporting. All right, next, unsecured credit cards. So again, we just got a thin credit profile. So there's a couple different routes that we could go to actually get unsecured credit cards if you don't want to mess with secured at all. The first one is fintechs. Now, there's a lot of new fintechs on the consumer side that will allow you to either go through the entire process and see what your limit's going to be, see if you get approved, see what the APR is going to be before you accept the offer, which would then be a hard pull, if it's a hard pull at all. Or some of them don't even have a hard pull at all. Like CrowdFit comes to mind, the Apple GM card, if we lock down our TransUnion, that's not a hard pull. If you come up here to soft pull offers, soft pull credit card offers, there's over 80 that you can check out right now to see if you pre-qualify. Now, again, that doesn't guarantee that you're going to get approved, approved, but you could get a great idea if you're going to actually get approved or not. Now, it becomes even stronger if we start to match it up with, let's check out the recommendation engines in like our Experian account and Credit Karma and, you know, your NAV account in these different accounts. Now we're starting to see that like we have high odds of this card over here. We're pre-qualing for it. We got high odds over here. Maybe we're starting to get mailers for it, right? You start to see that we can put together a really great idea and plan to actually pull the trigger and execute on those cards. So I would stick to that idea and that concept on the unsecured side, just to, again, make sure I have the highest possible odds of getting these cards, because again, I have a thin credit profile. Next one is relationship banking. So this is what I call it. All that is that we go in, we got to have capital. We got to have some cash flow to deploy. So we go in and we set up basic checking savings. Maybe we get into some money market accounts. Maybe we get into some IRA accounts. We move over an IRA, a 401k, something like that. Or we start to set up, you know, pledge loans with Navy Fed or something like that. And we essentially manufacture a transactional history with them. We can do that. What's funny is we can do this on a personal side. We can do this on a business side all day. And what we start to get out of that is, because we have a thin profile, this is extremely valuable to use this. Now, if you've got over an 800, you got a thick credit profile already, a lot of this stuff is like kind of Mickey Mouse. It doesn't work for you. You don't need it, more importantly. But if you are falling into this thin credit profile category, then, you know, especially with Navy Fed, we've seen now how many videos have we documented on this channel, like probably over 20 now, where people went in, did relationship banking, built a relationship with Navy Fed, got the bag, got a 20K card, you know, got 80K maxed out on their credit cards, et cetera, auto loans, home loans, all that, right? Speaking of auto loan and home loan, that's another thing that we could do, because again, our credit profile is just thin. So we could go get a mortgage, or if you're already planning on this, I wouldn't suggest to go buy a house just to thicken up your credit profile, but a mortgage or an auto loan is going to show up as an installment loan, but it's going to prove a few things. First off, mortgage is like what, 100,000 or more. Auto loan is somewhere between 30 to, let's say, 100, because cars are getting more expensive now. So by having that on your credit profile, it will mess up your DTI, right? But it will prove that you're able to handle a larger debt load, right? As long as we now execute on that, it's starting to report, we're paying on time. Even though that's got short payment history, it will prove that you can handle a bigger debt load. And it will prove that, like, for whatever reason, banks love to see what I essentially think is a normal human. And all normal humans apparently have a mortgage, they have auto loans, they have some credit cards, some installment loans or personal loans, things like that, right? So again, that just plays into that. And then lastly is run up limits and pay them down on existing cards. Now, what's interesting about this is there's some people to this day that swear this is how you get credit limit increases at banks like Discover, on your Discover cards. I've even heard this talked about with Apple, getting your Apple limit run up to 30K, 50K limits, is by doing this. What you're essentially going to do is, I assume that your cards that you're using now, you're maybe allowing a couple $100 at max to report, but you're probably using it and then paying it down. And you're not even probably using it that much, because let's face it, you probably got like $1,000 limit here, maybe $2,000 there. This strategy is, let's start opening up the usage on that. What we're going to do is we're just simply going to use more of that. Let's say it's a $2,000 card, run it up to 2,000, pay it off before the statement, before it actually reports, because you don't want to report a maxed out card. That'll drop your score like tremendously. But I'm just saying, like, use more bandwidth, more width of the card. That's going to benefit you in a few different ways. Two that I can think of off the top of my head. First is that you're making yourself look better for automatic credit limit increases. But if you're going to pull the trigger and ask for a credit limit increase, they want to know that you're using the card, especially with a lot of these fintechs. You got to be using the card for them to want to give you more. And then secondly, if you want to get a second card with that institution, well, I'm already using this one and I'm clearly hitting the limits of this one. So it opens up that conversation of like, look, love this bank, I want to do more business, but I need a higher limit. So they're either going to give me a higher limit on the existing card or give me a second card, give me another one, right? So that's why we would want to deploy a strategy like that. And then another one that I didn't even cover on this list, which would be a personal loan. We could branch that in with mortgage and auto loan. But again, that's going to report as an installment loan. And that is just another tool that you could deploy to show that you can handle a larger debt load. It helps add the credit mix, which is 10% of your FICO score, et cetera, right? But anyways, I just wanted to give you this quick list. So that's 8 things that you could do right now. You're not lost. You're not out there on your own, right? There are options for you if you've got a thin credit profile. So today, what we're going to do is explore a very recent, like within the last couple of days, case study of the technique that became popular. I think it became popular in like 2020, but basically calling up the bureaus and getting inquiries removed. So there's a lot of different ways that we can do this. Credit repair is something we don't really talk about on the channel that much, but this is just such a good slam dunk recent example that I wanted to share it with you. Okay, so let's get into it. First off, the easiest place to get inquiries removed by calling in is Experian. Always has been, probably always will be. And the hardest is Equifax, TransUnion, depends on who you talk to. I think TransUnion is still doable. You just got to get used to them telling you no. Equifax, I think, is the hardest, okay? So understand, if this isn't working, then we can go to the CFPB and we can go to the FTC and we can submit claims and submit fraud cases that way. And that's another way to get inquiries removed. Inquiries, by the way, are the easiest thing on your credit report to get removed. Outside of spare addresses and extra names and all kinds of other goofy stuff like that on your basic information side, inquiries are the easiest thing to get removed. So we actually have a lot of people in the community getting this done on a regular basis, but this was just like so fast and they were so excited that I wanted to share this with you. So here's how this went. On the 19th, they called in, did this, went through the process, basically just said, hey, essentially there's fraudulent inquiries on my report. I didn't approve these, which, by the way, you want to do this with inquiries it wasn't approved. Now, it's even better when there are inquiries that came from like some subprime type deal that you didn't even know about. Like, for example, when you go and get a car, you don't know this, but a lot of times they'll shop around your credit and then your report will come back with 10, 15 different inquiries. That is nasty business. And I don't like that. And I don't agree with that. So that's what happened here. These were all essentially farmed out and shopped around when she went and got a new car. So that, I think, does make it a little bit easier because they can see that the date was right around the same time. All these inquiries hit, like what happened here, and your average person is not going to go out and apply for 16 things on one day. So the more of them that are like kind of grouped together, I do think that makes it easier. But here's what happened. On the 19th, called, did the business, 1 a.m. that same day, so technically rolled over to 4:20, all of them removed. Look at this, Bank of America deleted, Cap One, Auto deleted, Santander deleted, Santander again deleted, two in one day, come on guys. Ally Financial and Factual all deleted. Next, the very next day, so I think this was 20th to 21st, we tackled TransUnion, right? And so again, same thing, call and get the job done. So here's what happened here. And this you'll see way more often with TransUnion, but you'll also see it with Equifax as well if you want to call in on that. Is called in, spoke to a representative. Initially they said no, can't remove the inquiries, and stated I needed to do blah, blah, blah. I said, nope, these are fraudulent. I should not have to take action. I did not authorize these inquiries and I want them removed. So the rep insisted, and then she restated again. I just restated that it's not my responsibility to correct inaccurate reporting by TransUnion and I wanted it removed. She told me to hold on, came back after a long awkward pause, and they were removed. Then she transferred me to a specialist who validated who I was and confirmed that the items I requested were removed and would be reflected in 24 to 48 hours on TransUnion reports from everything from FICO to Credit Karma. So there you have it. Here we are, 2023. The stuff still works. You can call in and get them removed. Do not expect it to be easy. Expect to hear no. So that way, when you do hear no, you're not throwing off your game and fumbling over your words. Expect them to say no once or twice. Stay assertive. Restate the facts. Do not go off script. Continue to hit them until they say yes. If they don't, say thank you so much, hang up, call right back, speak to another rep. Well, wait like a minute or two and call and talk to another rep. Try the same thing again. Do this over and over and over and over and over again, and I guarantee you'll have much higher rate of success.
All the mistakes that I made trying to rebuild my credit, right? As you guys have been following along, I went from a 460 to 760 credit score on the road to 800, right? That's one of my personal goals. The first thing I did was I focused on crappy credit cards. Because when you're in a subprime category, 460, 500s, you got derogatories, you got baddies, what are your options? Who is really extending credit to you at that point, right? So this is like Credit Ones, this is the Indigo cards, this is all the borderline predatory offers that you see on Credit Karma and Wallet Hub. Like when you're not getting any offers from like normal, legitimate credit card companies, that's the crap that shows up at the bottom. And those are all subprime cards, right? Now, thankfully, I didn't fall into that trap. I almost pulled the trigger several times, you have no idea. But when you're looking at a card that's gonna have maybe a credit line of $250, $500 if you're lucky, and it's got a $100 annual fee and there's all these other fees associated with it, it's like there's no point in getting it. Going out and getting crappy cards. I went out and I got 2 Capital One cards. One I think had a $200 limit, one had a $300 limit. So that was the first mistake. Second mistake is along a similar vein as that, is I went out and got all these online trade lines. So a trade line is different than a credit card. You get no card, you can only use it at this one domain, this one store or shop. And a lot of these have overpriced, marked up junk that you have to buy in order to open up the account and, get them to start reporting to the credit bureaus, right?
So this is My Jeweler Club I went and got, New Coast Direct, and a couple others, right? And I don't even think My Jeweler Club is around anymore. And at this point, all of these were reporting to all the major agencies still, right? So I got lucky on that front, and it did help my score, right? Because every time that we add a new credit, it does ding us because it takes down our average age of account, but at the same time, simultaneously, it is stretching out the amount of available credit we've got, so it makes our utilization look better. You need to pay more attention to the utilization. And so anyways, that brings me into the third point here. Instead of keeping my utilization down, I was focused on just using those cards as if they were free money. Now, this is a huge mistake a lot of people make. And I think, again, this comes with education. But when you're treating this like free money, you will treat it very poorly. You're going to not take the payment dates serious enough. If you don't have the money, you're just going to say, oh, well, you're going to continually use way too much of the utilization and max out the card, not pay it down, because again, this is free money. There's no accountability there within what you're doing, right? So that was a huge problem that I had in the beginning as well. Next, I was very hyper-focused on removing baddies, derogatories, bad things on my account versus just establishing great relationships and transactional history with banks that I actually liked. I spent all this time, money, thousands of dollars, hiring, credit repair agencies and individual guys and friends of friends of friends, all taking me for a different kind of ride. And trying to get all those things removed took over a year. And we got a lot of them removed, but at the end, there was still the bankruptcy. At the end, there were still some of the larger charge-offs. So what was the point? And if I would have dedicated, I argue, if I would have dedicated that same time to building out relationships with institutions, transactional history, getting into a bunch of their different products, and at minimum, a secured credit card, and just let that sit for somewhere between 2 to 6 months, I argue I would have been much better off. And now seeing a lot of the personal stories shared in the community, I know I would have been better off. So that was a massive mistake on my part. And I know that there's a ton of people right now, some of you probably watching this, that are going out trying to completely remove and scrub the credit profile clean. And they think that by getting rid of all of this, now I'm gonna get this huge uptick of a credit score. And you don't. You really don't. It makes your approval odds better when you're down in the dumps, like sub 600. It does help with that. Again, I would argue that at that time, we should not be trying to get new credit. We should be building relationships, opening up high yield savings account with whether it's Amex, Chase, Navy Fed, whatever credit union you want to work with, or major banking institution, right? That would be more worthwhile. That money that I took for credit repair, if I would have just sunk that into secured credit cards, savings accounts, relationships at these institutions, I would have been better off. I know that. Next, I was focused on and constantly watching videos trying to learn like hacks and tips on, people who won't do a hard pull and a way to sneak in here. And it turned into this thing to where it's like you find yourself spending all this time and acquiring these cards with the shopping cart trick, with all these other tricks and hacks. First off, you don't even want the card, but you're filling up your profile with a bunch of junk. So you're thinning out your average age of account. You're adding too many new accounts, too many new inquiries, because a lot of times the soft pull trick hack thing ends up hard pulling you anyways. Yeah, you got approved, but it was for $200, $500, etc. So again, I would argue that that's not worthwhile. So you see, like what we've now been covering on this channel over the last, year is the same stuff. And we're just kind of talking about it in different ways. And I'm talking about the personal mistakes that I made and the things that slowed me down, because I want you to go through this faster than I did. I think an 8 to 10 month window is the perfect amount of time that you need to completely change, fix, reshape your credit profile.
I actually want to cover a FICO forum post that I thought was really, really good, so we could talk strategy about a situation if you're in something like this. The situation is that they've got closed credit card accounts and they've got active. They're at about 90%. It turned out to 103% utilization on their accounts. And they got a bonus. They got a $3,500 bonus. What do you do with that? You've got a $13K card that is closed, and you got a payment plan worked out on that. And you've got active cards with 103% utilization. But what do you pay down first? Like you got this $3,500 balance. What do you pay down? The comments were actually really, really good on this too, which just shows you the quality of these forums. And FICO forums are one of my favorite places to go. And so I was perusing this naturally as I do on the weekends, and I found this gem. You would want to focus on the highest interest cards first. And if you could simultaneously pay off a card completely with that, then that would be where you want to focus. So regardless of the closed accounts, open accounts, it's about who has the highest interest. So that's really the main metric that you want to look at and the variable in which you want to use to make the decision on who gets the most money. In this situation, you'd have people doing all kinds of strategies. Pay it to the closed one, pay the open ones, pay a little bit across all of them, right? Those would all be common strategies that we'd hear, but you have to take into consideration how much you're paying out every month in interest. So if you needed to sit down and break down those numbers of what the actual interest that you're paying every single month was, forget credit scores. Your credit score is already in the dumps. Just let that, set that off to the side for now. And all we need to really focus on is what to do first, right? Yeah, with this one, I think that's what he ended up doing is he ended up paying down the highest interest cards. And I think he was able to pay one off and then put a dent on the other ones that were open, right? So that brings the utilization down. He brought it down from 103%, I think, to 84%. So then he's getting another bonus soon, another $1,500 bonus. So what if you were in a similar situation, right? You found yourself getting a $3,500 bonus and then maybe another couple $1,000. Well, what would you do again? You would continue literally the same plan because you got your payment plan with the card that's already closed, right? And so that's not going to change. It's not going to go away. So you just continue to chip away with these bonuses. It sucks and it can be disheartening if you're in a position to where, what if the entire $5,000 or $10,000 or whatever your bonus was didn't even bring a single card down to zero? That would be insanely disheartening. At some point, you got to stop digging yourself into the hole. And you got to start focusing on how to get yourself back out. We got to start climbing back out of the hole. The worst thing you could do with that money is go take it and put it into something that is not gonna, save you money. Unless you can go get yourself 26 to 29% every single month. So then you could take the profit that you're making off of this other vehicle and move it into these credit card payments. Unless you could go do that, which I doubt anyone could. Unless you're, a money manager. And if you were a money manager, you wouldn't be in this situation to begin with, I would assume. It's going to be difficult to go and find yourself almost 30% APR every single month that then you would be able to pull out and not leave active and pull that out and then make your payment. Let's take a step back and look at the mindset. Once you kind of get into a situation like that, and I've been there, is you actually do start to try and justify going and spending that on dumb shit, like on more clothing or external things to try and create internal happiness is essentially what you're still in that battle, because that battle is part of the problem and part of what led you to where you're at right now. It was for me anyways, and I really don't think it's that different for everybody else. Yeah, you start to try and justify maybe I should go get some escapism and get a new game console or get some new clothes or get some new this, get some new that, go fix my car. At some point, like I said, you have to really take stock of where you're at and jot all this down and take inventory of everything that you got going across your life right now, and then start to weigh out and measure what needs to be tackled first. I don't know, man, almost 30% a month, that needs to be handled now, because there's not a whole lot of other things that stack up like that. You probably won't see much of a change in your credit score. Going from 100% utilization to 84%, I don't know, what would that be? Maybe a 5-point tick on that? Maybe no change at all, depending on what FICO model you're looking at, because it's already dumped so far. But yeah, I mean, you are moving forward, right? And so definitely can start to feel good, build back some self-esteem in that sense, because we're chopping away at our commitments, right?
Advice on applying for credit cards. I find some fascinating stuff in the MyFICO forums, and I wanted to go through this specific example with you. Okay, let's dive in. Advice on applying for credit cards. I'm not sure if this is the correct place, given my FICO scores. What would be the best credit cards to apply for? Also, in your opinion, what credit cards should I close? Okay, so what should I get? What should I close? Utilization is at 14%. Here's our scores as of February 2023. Experian 665, Trans 675, and Equi is 655. Credit cards that she's got: Discover IT, that is the Double Cash City. We got a Credit One in there, yuck. And it's not even the Amex. We got a Quicksilver in there, Target by TD Bank, I think, right? Macy's, that's a store card, and then this looks like another Overstock, yeah, another store card. So $100, $150, $300, $300. We're clearly rebuilding. She's given us nothing, and I can already tell you right now, she's got derogatories on her account, or she went bankrupt, or she's got something going on, because these are all mostly starter limits. The highest limit she's got is 2,000, and she got rid of Capital One secured. Oh God. So she got hit with all 3 inquiries for a secured card. Yuck. So she's walking through the rebuilding phase. They start you off with $200 or $300, and then you pay 6 times, 6 on-time payments or something, and then they bump you up to $500. So she's not even to that yet. Yeah, I mean, I would definitely look at cashback cards. Okay, so, and these are good contributors. South Jamaica is a really good contributor. American Express, Blue Cash Every Day. Yeah, could try and get in there. I mean, essentially what they're going to do is they're going to look at your credit profile, and they're going to say, oh, well, this person's got a bunch of $100 limits, $200 limits. That looks bad for the most part. Sometimes that doesn't have a negative effect. I find that more times than not, it kind of does. It influences 100% what limits they're willing to give you. That being said, is American Express doesn't start with like $500 limits. It's usually like $1,000. So your worst case scenario is probably like $1,000 limit. Now you could go with a Delta co-brand or any American Express co-brand because it's considered easier to get in, possibly a different underwriting process. I used that way to get in with American Express when I was rebuilding and had derogatories on my account. It worked great. I got $1,000 starting balance. The first answer that is probably more in line with what I'm talking about, I would go Navy Fed, like if she can, obviously. And the reason why is because you get in there, and if I don't have an ideal profile, then I need to build up some data points and some transactional history with them, which is where the whole idea of the pledge loans and the money market accounts, direct deposits, et cetera, et cetera. We know it works. The whole point of doing that is if you have a subprime credit score or if you have a less than ideal credit profile. If you got a great credit profile, don't even worry about it. Like you could just go in cold and get cards. Well, she doesn't. $80,000 max exposure on credit cards with Navy Fed. You can work yourself up to $50,000 on Penn Fed. And I don't know with USAA, I don't remember. You usually can get higher credit limits on there, starting limits. And that is going to influence then new cards that I get, new credit limit increases that I get. So I would love to start there with somebody in this situation. That would be my advice if they can. Now, if that's completely out of the gate, then we need to start elsewhere. Another thing that I'd be looking at immediately is how can we remove these derogatories? Let's use some pre-qualification tools to see what else we might be pre-qualifying for. Like, let's go and check out the Apple card. Let's check out some more of these other cards that we can kind of lock down our accounts, Truist, etc. And let's see if we can get something going there. How long has it been since the first and last card? That's a great question. So let's see, there's 3 pages of this. We're gonna cruise through this. Oldest to youngest. So it looks like 2020. And most recently was the Citibank, January. That's not bad. So it's definitely because this card here positively influenced that. The cards to get rid of, it's going to affect their history too much. All the crappy ones are from 2020. Just leave them open for now. But you want to dump these 2 store cards like whenever you can. Like let's go get another 30, 40K in credit and then let's drop these 2 right here. I did have credit back in 2015, but was young, dumb, and uneducated about finance as a credit. Hey, we all went through that, trust me. Maybe not everyone, but I did too. Luckily the derogatory marks, will be off my credit report in the next year or so. See, I told you, there's got to be derogs. That'd be impossible not to. Okay, so now we responded to this one. Oh, I did request an increase from Discover a month or so ago, one from 500 to 2,000. That is good. That is good. So this card is really helping. So from everything moving forward, that should positively influence. Like an Apple card would be positively influenced from this. Hopefully you could get $2,000, $3,000 limit, if not more, if you were to go that route. Thank you for your input. Cool. Thanks. Welcome. Mind expanding why you would close the credit one? Because it sucks. That's why. They're all trash. Like literally get rid of all these from credit one on over. Get rid of them. They're junk. But not all at once. Not right now. Go get all your new credit first. You do not close those accounts before you go get new credit. Once upon a time, I did have a credit card with Navy Fed. Mom served out Navy and Army, but 18-year-old me was not so smart paying off the credit card on time. I do recall them giving me a significant credit line. Probably not the smartest on their part. No, it was not. And this is what we talk about. This is why we talk about this on the channel so much. If you burn the bridge with Navy Fed, then so that X's that whole thing out. You could maybe go Penn Fed USAA, start there. But otherwise, yeah, maybe try and wiggle your way into Amex. I'd look at some other pre-qualifications, like Truist would be another good one to go with. Apple, like the GM or the Apple card would be good, and really see where you're at there, right? Because we really need to get like a big domino. You could also add AUs. I know that we don't really talk about this on the channel that much, but if you could influence a nice size trade line on that account, like some $20,000 trade line, that would positively influence every card limit that you're gonna get after that point. And to do it just for that sake, so that you get higher limits with like the next 3 or 4 cards, I would definitely do that. Like there's maybe 3, 4 cards you could possibly get, maybe 10, 15,000 in credit if we're lucky. If we don't do the AU route, if you did the AU route, you might get upwards of 20, but then you gotta get those new cards on, and then we gotta clean that profile and get rid of the derogatories. The scores are they're gonna go up when the derogatories are removed, but down when we start closing out accounts and start really refining things down. But like that's the soft outline of the play that I would suggest. Get yourself into position for like another, 3, 4, 5 months, and then that would be the big one. That'd be the bigger app spree, that more stuff is cleaned up, scores have rebounded, we've now got some history on the new cards, and we could go back to the bureaus that it looks like you have like no action inquiry-wise on the bureaus, the age of accounts, and when you last got new accounts over the last 12, 24 months, all positive. Another thing you could be looking at doing is building out checking accounts with credit unions or institutions that you want to bank with. Understand credit unions are usually pretty conservative and they don't like to see derogatory marks. 25 different trade lines broken down into 4 different categories that hopefully will help you get up over that sweet spot of having a thin file, which is 5 or less, into a thicker file, which is 10 or more. After 10 or more trade lines, really that's when you can start to look at branching out from personal credit and getting sole proprietor credit and starting to build up entity status that way. First, let's take a step back, and it's interesting because I consider trade lines something different than they are. So let's quickly talk through that and then we'll get into the list. So a trade line is a summary of every revolving or installment credit you have on your report. Simple as that. What I really considered a trade line for the longest time was like junk, online junk. That would like My Jeweler Club and New Coast Direct and all those different options like that, because it was technically like this online account that represented money that was being reported on your credit report, but you couldn't really do anything with it. So the whole point was to obviously try and thicken up your file and hide utilization if you got yourself into trouble with spending too much money and getting your utilization up too high. So savings-based trade lines, this is where you put up a certain amount of money every single month with a flat rate fee, and it is reporting as an installment loan on your credit profile. Next is rent. So there's two sides of this. The tenant can pay or the landlord can pay. I'll go through options for both on that. Utilities, cell phone, bills like that you can add onto your credit report. There's a few options there. And then of course there's subscription services. This is newer, but I think this is a niche that has a lot of room for growth, like a sub niche within credit. Basically give a reported amount of credit limit and then allow the person to spend X amount per month only on subscription services. So these are different ways to add more trade lines onto your account to thicken up your profile, or if you find yourself in high utilization territory, this can be another means of trying to thin that out. Now, I would start, if it was me personally and I had the utilization issue, I would start with like easy to get soft pull approvals, your Truist, your Apples, your GM by Marcus, some of the Comenity cards, some of the Synchrony cards, even though Synchrony sucks and they're closing everybody's accounts, is again, just to get that for X amount of time while I'm trying to make some other play to get my utilization to look better. Best trade lines for bad credit, but it's not necessary. These are really for anybody that needs to beefing up their file. So we got Self Inc, Credit Strong, Kovo, Kickoff, Meet Ava, and Lockbox. My top 3 would probably go like this: Self, Credit Strong, and then Meet Ava. And the 3 worst are probably Kovo, Kickoff, Lockbox. So let's dive into it. Self Inc, the reason why I like this is because actually I think this loan right here, this $48 across 12 months, is the best because the APR/interest rate, which those are two different things, by the way, is the best rate. I like that style of it. And there's really no muss, no fuss with Self Inc. I've used it before, and I think that they're great. $9 admin fee. Most of these have admin fees. Reports to all 3, and after 3 months, you can take a minimum of at least $100 and move it over to a Self Inc. credit card, and then do what you want with from that. But you're basically funding your own credit card. If not, you go through the whole term, pay it all down, and then you get your money at the end minus the fees that they take, right? Credit Strong is similar, the only difference being that $15 admin fee, their rates, their APR is about the same. Is being reported as $1,000 to $1,100 trade line, depending on what you're getting. And of course, we've got much longer terms. So 24, 36, and 48 months. So that's really the only difference. And then Meet Ava is $21 per month, reports to all 3, 12-month commitment. Can't cancel early. I don't know what that actually is being reported as in terms of the size of the loan. And then the reason why I said, Lockbox, Kickoff, and Kovo are kind of the worst. So Kovo, it's $10 a month across 24 months installment loan, reports to all 3, great, no credit check, instant approval, as with most of these. 0 interest, 0 fee. That's not true for all of them. The Credit Strong and Self, they both have interest fees on them and admin fees, but on these, Kickoff and Lockbox, there's 0. Job interview skills, self-confidence, and self-esteem, entrepreneurship, which, man, maybe we should try and do some sort of collab with them. Wouldn't that be cool if we could do like credit education? And there's a 30-day refund on the courses. Again, 0 interest, 0 fee. Okay, Kickoff, revolving installment. There's 2 different options. One reports to Equifax Experian. The other one reports to Equifax TransUnion. Again, no credit check, 0 interest, 0 fee. Reports a $750 trade line. What was the deal with Kickoff? They got 2. They got a credit account and a credit builder loan. Yeah, credit builder loan is 1-year savings plan for $10 a month. And then this account builds monthly payment history, helps reduce your credit utilization. I don't know. I think that was it. I think you can buy good. Oh no, that's right. You buy goods off of their site. It's like old school trade line to where you have to buy stuff off their site. It's not really anything other than that. And then Lockbox is the same thing, like you're locking up your money, but the difference is that you can actually get APR on this money, or interest on this money, APY. Okay, let's say you wanted to save $1,200 a year. We'll sell you a lockbox. So they're essentially selling you based off of like from bigger banks. They've like pulled together a bunch of banks and they're selling you like a fitted out, what sounds like security deposit. You know, they're handling the transaction for you. That sounds like, and then which you pay 12 interest-free payments of $100. So you pick how much you want to save, I think, and then they tell you how much it's going to be per month. But what's weird about it is there's something when you go to unlock, the Flexi Unlock Premium add-on and unlock into an existing account for $40. So they'll send it anywhere you want. When you're done, it goes into your lockbox unlock thing on their site. But then if you want to send that anywhere else, it's $40 fee. Not bad, but next, rent trade lines. I have these broken down a little bit different. Now we've covered some of these in the past. We've covered rent reporters, rental karma, and boom pay. So if you want a detailed video, we went pretty in-depth into boom pay. These are just all the goods, right? So rent reporters, there's a one-time enrollment of $94, and it looks like there's $9.95 a month, or an annual plan cheapens it by $1, so $7.95 a month. Boom pay is enrollment fee of $10. You can pay $2 a month to move onwards. So from this point forward, you pay $2 a month, or if you want to go 24 months into the past, you pay $25, and then you just pay $2 a month from there, moving forward for everything in the future. Hope that makes sense. Again, they're on the cheaper side. Rental karma, initial setup of $50 and service of $8.95 per month. Then we've got level, rock the score, credit my rent, and payment report. And they all have setup fees and monthly charges, right? We've got all that broken down for you. That's if you're reporting it as a rentee, right? Or you can have the landlord report it for you, right? And so the benefit to this is like, this is one of those low-key trade lines that helps with your age, helps with your credit mix, and is just usually gonna be something that's longer, and it's a big fat payment every single month. I mean, think about it, your rent payment, what is that, $700 on up, you know, if you're lucky. Also too, if your landlord, maybe the encouragement could be a bunch of you, go to your landlord and get him to pay for it, right? If you're living in some sort of like complex condo, apartment, etc., right? Or duplex, triplex, you can get them to do that. And the upside to that is with some of these, like with BoomPay actually offers on the landlord side is they've got like tools in place, which are cool. So like this right here, they're testing out a Boom Split, which is in beta right now. And that's a flexible rental loan for like, if you're having cash flow issues. Just tools like that, I think are really, really good to incorporate. If it makes sense for them to do it, then you can talk them into doing it and you don't have to pay anything. And then you're getting that all pushed onto your report. So there is Clear Now, Pay Rent. I don't know how to pronounce that. Susu, Silent E maybe. BoomPay, JD Credit, Built Rewards, Rent Dynamics. Next, utilities and cell phone payment trade lines. They say that they'll let you do cell phone, utility, and internet services, but on both their plans, they're just talking about utility payments, and they're only talking about it reporting to TransUnion on the personal side. So they also offer something on the business side. I don't know if that's why they can mention that, because on the business side, they allow that. I'm not entirely sure, but they've got two plans, and both of them only report to TransUnion, so that's kind of rough. So you could do that, and then there's an Experian only one, which is through Experian. You have to have, I think you gotta have a paid account, but maybe you can do it for free, is you can get your utilities added directly to your Experian credit report. So again, it's just another thing to have showing on positively on the credit profile. Make sure you're obviously keeping up with your utility bills, because it will show up as a late payment, you know, just like anything else would, and we don't want that. And then finally, let's get into subscription services, right? This is a cool one. I think these are up and coming. We did a dedicated video on Grow, talked about how like you could use Grow, and I think Grain was the other tool, and you could bump yourself up 60 to 150 points, depending on where your profile is sitting. There is a sizable amount of testimonials and first-hand accounts actually with Grow Credit specifically, talking about huge gains in credit scores. So they've got 3 plans. I like it. They have a free, and then they have a Grow and Accelerate, and each one reports, you know, a different amount. Let me just pull up my my image here really quick for you. All right, so here we go right here. So there's Build Secured, Grow Membership, and Accelerate. Accelerate reports $1,800 limit, $600 limit here, and $200 limit here. Be honest with you, the only one really worth even looking at is this one here, if you ask me. And plus, I mean, most people are spending, you know, over $60 on subscriptions anyways. So Grow, I like that. Reports to all 3, easy, right? Then there's Stellarify and Meet Ava. So this Meet Ava one, I like a lot. I would actually say it's close between this and Grow. $25 per month that you can allocate to subscriptions, but it reports as a $2,500 credit limit. Now, I hope that's all correct. That's what they say on their website. I also don't know, like, okay, is it $25 just for the whole month flat rate? Or is it $25 because then 7 days later they debit it from your checking account? Does it then reset to 25? So I could technically spend like 3, 4 in a month, depending on how fast it clears, how fast I get the credit back, you know, etc. I don't know, but I like this one a lot. And then Stellarify is kind of fits in the middle with a huge upside potential to this, which is this Prime. It's $9.99 a month, and you can do up to $25,000 in bill pay. So this one's different. This offers membership plans, and the fee is charged the day that you sign up. So it's that day every single month for the membership, right? No credit check, no interest, no deposits, no nothing. No reported limit to the bureaus. Instead, it takes every bill that you give it and like kind of feed it. And once it pays it and all that goes through, which is all done through a virtual credit card, then it reports that as just a paid bill. So this could tactically be a really strong tool, even like paired up with one of the other Grow or Meet Ava even, right? Because Meet Ava, another $2,500 limit. But if you were paying everything through a checking account already, right? So you might want to just move some of that over, move some over to Meet Ava or Grow, and then move the rest over to Stellarify and just be paying that way, you know, depending on the size of your bills. That could really add up too. I think that'd be powerful.